financial advice for dummies.
Okay.
I'm not saying you're a dummy. I'm not saying that I'm a dummy. I'm just saying that there are some dummies out there, and this is some financial advice for the people out there. So there's this guy. His name is Jeremy Schneider. Who he is almost irrelevant, but his story is very important. He's a multi-millionaire investor. The guy's made millions. And he says if he can start all the way over, he'd put everything into one specific investment called a target date index fund. Let's pull up this story.
Yeah, it's up.
So I'm all about this story. This, like, if you want to know what Saz's wheelhouse is, bingo, we got it. So I'm all about this. The proof is in the pudding. I talk about investing in index funds, target date index funds, ETFs, set it and forget it. Let the good times roll. Don't try to overthink it. Don't try to beat the market. Just be in the market. It's not about day trading. It's about decade trading. I say it all the time. And this guy just proved my point. So this guy, Jeremy Schneider, says, look, I'm worth almost $5 million, $4.5 million. I see you, Jeremy. Well done.
Good job,
he says, if I can start all the way over, I'd put all my money in a target date index fund.
What is
so
that?
Basically, I'm going to, you're going to learn.
Oh, I need to learn.
So look, he's got all sorts of investments going on. We talked about index funds. He's got real estate. He's got bonds. He's got stocks. He's got businesses. But again, if he can go back in a time machine and start all the way over again, he'd put it into a target date index fund, specifically the VFIFX, aka the Vanguard Target Date Retirement Fund. He wouldn't have bought Apple. He wouldn't have bought Amazon. He wouldn't have bought a house. He wouldn't have bought real estate. He wouldn't have bought crypto, apparently. Target date fund. Okay, so you're right saying, what's that? So let me just tell you this guy's backstory, and we'll get into what this stuff is. All right, so basically he said, look, I had to learn this the hard way. I started off in my 20s by, quote-unquote, doing dumb stock picking on E-Trade, which is E-Trade is basically like back in the day Robinhood, which is Robin is today. And he compared it to basically throwing spaghetti against the wall, buying and selling random stocks just because I like Reddit. Sounds like I'll give it a shot.
Yeah.
Lose. Without any serious rhyme or reason, just throwing spaghetti on the wall and see what sticks.
Yeah.
That was his mentality. But then all of a sudden, target date index funds comes along. And I'll explain what that is. We know what index funds.
Yeah.
Right? So rather than picking a stock or a bond or a spigot,
league.
you buy the entire S&P 500 as an example.
Boom.
And rather than trying to get in and get out and pick the stocks that you think are going to win, you buy the entire market.
Yeah.
Buy the entire S&P 500 index fund. It's not actively invested. It's passively invested, so you're paying a lower expense ratio. It's cheaper. It's easier. It's not complicated. You keep it simple. That's essentially what an index fund is. But a target date is basically saying, I want this money in 2040. Or I want this money in 2050. That's when I'm retiring.
Okay.
Or I want this money by 2030. And the target date, essentially, it's a strategy based on that particular date. So let me break this down what this means. So it's all about risk. When we talk about investing, it's all about risk. We all know risk, return, risk, reward. We get it, set and forget it. And you pick the target date of when you want the money. So for instance, if you're going to do a retirement fund, a 401k, we talked about that's like the luggage. All right, now you got to put clothes in the luggage, right? So all right, cool. I'm going to do an S&P 500 index fund. I'll do it through Vanguard. When am I touching this? Well, I'm 25 years old, so I plan on retiring when I'm 65, so in 40 years. So I'm going to do a 2060 target date fund. So meaning the younger you are, the more risk you can take, right? The older you are, the less risk you can take. Does that make sense to you?
Keep going.
Okay, so let me explain risk. The younger you are, right? So with investing,
right now,
So if it's money that you need in the next 6 months, year, 2 years, just straight cash.
Yeah.
Don't invest that. Stay like that. Just keep it in the bank.
Yeah.
Put it in a savings account. Put it in a checking account. That's money you're going to need soon.
Yeah.
If it's money that you're going to need long term, 3, 5, 10, 20 years down the road, even longer, that's investing. Okay. There's two elements to investing: time and compound interest. Time and compound interest. Right. So when you're young, your investing horizon or your time frame is longer. Dude, I'm 25 years old. I like a lot of investing has to do with retirement planning, So when I'm 65 years old, how much do I want in the bank? 0? When I'm 65? No.
Yeah, no.
$500,000? $1 million? $5 million? Like the more you have, you can retire and do nothing at a certain age. And we'll talk about that further. But the younger you are, the more risk you can take. So when you talk about risk and risk tolerance, that's stocks. That's a heavily weighted stock portfolio. So maybe you have 90% stocks in your portfolio, only 10% bonds. Because bonds are basically for stability. Old people, do your old person impression.
Oh, I remember this bond I had.
Exactly.
It must have matured by
Exactly. So when you're 60 years old, when you're 70 years old, you're retired, you're not going to have 90% stocks. That's risky, bro.
Yeah,
that's certainly risky.
bro.
You might go 70% bonds,
Right.
30% stocks.
Okay.
Like, if you want to know anything about investing, this is all you need to know. Here it is,
folks.
Do this. Go ahead, do this. Go ahead. The younger you are, the more stocks you should have,
Okay.
less bonds. The older you are, the more bonds you should have, less stocks. Because the younger you are, the more risk you're willing to take. I got time. The market F's up.
I see what you're saying now.
I got more time to make my money back. Risky. The older you are, God forbid there's a correction, you're going to lose all your freaking money if you're all in stocks.
Right.
This is it. If there's anything, you just got to know, this is it.
Guys, record the screen right now.
There it is. You know, David, some people are here. Some people are here. But where do we want to be, David?
We want to be right here.
We want to be up here.
This is what you do up here.
This is what we want to do up here.
That's all there is.
And that's what it comes to balance.
You can't do this.
It's weird.
I don't even.
So that's where you want to be. That's so, like, seriously, if there's a symbolic vision or metaphor to investing, young stocks, old bonds, and then just
young
play it.
John. Right.
Young John. But if you're like, hey, well, I'm 50, are you young or are you old at that point? I don't know. So you're in the middle. Oh, maybe you're in the middle. 50% stocks, 50% bonds. If you're 80, maybe 80% bonds, 20% stocks. If you're 20, exactly. If you're 20, maybe you're 80, 90% stocks.
Yeah.
20% bonds. That's it. That's it.
Close the show. This is it.
Drop the freaking mic. So again, if you're 20, 30, even 40 years old, you can have 80, 90% of your portfolio into the stocks, right? And what type of stocks? Maybe 50%. It's called a 3-fund portfolio, right? So maybe the majority are in U.S. stocks, S&P 500. Then you can have a percentage that are in non-U.S. stocks, global stocks, right? The world stocks, emerging markets, what have you. Maybe 10% bonds. Flip it if you're older and you're retiring because you want to have more stability, right? You're not looking for growth. When you're young, you're looking for growth. You want your money to grow. When you're old, you just don't want to lose your money. You want to have stability.
Right.
Right? That's why when you're young, you go out to the club, baby.
Hell yeah.
When you're old, what do? You just sit in your rocking chair. What do? You maybe play a little golf. You're looking for stability. Nothing crazy.
Yeah.
It's analogous. All right, so look. We did this. We did it. Like, I don't pretend to be like the investing guru. And I'm not Warren Buffett. I'm not even Mark Cuban, okay? But I know enough to know that this makes sense. When this guy says, look, here, pull up his portfolio, scroll down a little bit. Scroll down. That's the guy. He's worth $4.5 million. Congratulations, Jeremy Schneider. Bingo, bango. This is what his portfolio is now. Here's how Jeremy $4.5 million portfolio looks right now. He's got 52% in index funds, 27% in real estate, 12% in bonds.
Wait, can we switch over to the thing so the people can see? I don't know if you're.
Can you see that? And then it's just sort of diversified. All right, in a bunch of different things. But the whole point of a target date index funds is it's already diversified for you. So scroll down a little bit.
Yeah.
He says if you could go back in time and do it all over again, boom, 100% into an index fund. 100% into an index fund. So that just puts it out there for you. So look, again, I'm not pretending to be the investment guru. I am a personal finance expert. Like, I know all things personal finance, rent, buy, own,
and
car,
just
this.
happens to be a slice of that.
Investing is a major part of that.
Yeah,
major part of that.
Okay.
But this is exactly what I believe in. This is exactly what I talk about. Okay, I'm not a real estate guru. I'm not a crypto guru. I do like investing in the stock market, but I understand personal finance. And I understand when someone says, look, if I could do it all over again, target date index fund, it makes sense. It adds up. Again, when he was younger, he was throwing spaghetti against the wall, just picking stocks, who knows, picking crypto. I like Dogecoin. I like Tesla, whatever it is. Okay, you're just gambling.
Yeah.
This is a surefire way to get 10% returns, have your money grow over time, compound interest. Let it grow.
Let it go, bro.
Let it grow.
Talk is money. All we talk is money.
If you enjoyed that short clip from the Soscast, click here to watch another. Click here to watch the full episode, or just stay broke.